So let's bring in Ironsides Macroeconomics Managing Partner Barry Knapp. And I want to get to the conflict and first. Let's start with that, and the economic impact on it. Obviously, the longer it goes on, the more impactful it will be.
No doubt about it. And one of the things that's kind of crept up, and I've talked to a number of investors about this week that they hadn't considered was, throughout the course of last year, the concerns about the supply of treasuries faded. And that was because government spending growth slowed from 11% in fiscal year 24, Biden's last year, down to 2%. And so all the issues that pushed 10-year note yields to 5% in 23 and pushed them up during the election a year ago, that all faded. All of a sudden, we got a little bit of concerns that we may have to pay for all these munitions we just used. And we've got the IEEPA tariff refunds as a bit of an issue. And this, to me, is behind Bitcoin suddenly perking up, was the debt story and the fact that we may stall out on our progress around the deficit.
But you mentioned for a moment 5% was the number. Then we pulled back, and then we started going up, and 4.5 was the number. And now 4.1 is the red zone. Like, it feels like they keep moving the goalpost a little bit. I mean, is it just, do we worry as long as it's above 4? Because we dipped under 4 for a moment and it felt pretty good, although I was told we shouldn't feel good about that.
Yeah, I mean, I think that was the combination of concerns about AI just nuking the jobs market, and the numbers, ex tech and comm services for earnings were marked down for the first quarter. So yeah, growth should accelerate later in the year, but that CapEx broadening out story hasn't happened yet. And so a little bit of an issue. Listen, I think the progress on the deficit and debt has been considerable, but we're at war, right? And wars cost money.
Yeah, well, you mentioned AI, and I started with productivity. The productivity rate, the 6-year rate is 2.2, the 2-year rate is 2.5, now we're 2.8. Is AI part of that? Is this part of the AI story?
I've seen some evidence of AI contributing to productivity when I look at bottoms-up analysis, sales per employee of the tech sector, sales per employee of the communication services sector. That's what happened in the late 90s, was those sectors started to benefit first, and then it was the finance sector and some others. So there's some evidence of that. But remember, productivity took off in 2018 and 2019 in consumer services. And so I think the pandemic actually accelerated some of that. So we've got we had a good productivity story going even before the pandemic, and that's part of what we're seeing.
But is AI making a difference, though? Or is it too early to tell?
It's beginning to, as I said, in tech and communication services. Broadly, probably not broadly yet.
I'm pumped over this service number yesterday. Listen, I know in a different environment, I think this would be like the top story. A Six Sigma beat, the best since 2022, and everything you want. Services, new orders, business activity, even employment. In the meantime, prices came down a lot. As we head into the jobs number, though, you're not as optimistic that this will be reflected in tomorrow's jobs number.
Well, at the sound of being, sounding trite about it, the labor market will be the last thing to respond. And we've got low churn in the labor market. The jobs that are being created are in the healthcare sector at low wages. So it's going to take some time for the labor market to respond. First, I would look for that capital spending to broaden out beyond just Gen AI related CapEx. And it's in the earnings forecast going forward, but the first quarter expectations actually got marked down during earnings season. So
Barry, I got less than a minute to go. I want to ask you about the dollar. And the old petrodollar and the old, and the the end of American exceptionalism trade.
Yeah, I hated that trade. I'm probably going to run a chart this week of showing return on equity of the S&P versus the DAX or the Nikkei or everything else. This is the most profitable story. This is the one where productivity is booming. But what people didn't understand is when we went from being the biggest oil importer in the world to the biggest oil exporter in the world, the dollar's now a petrocurrency. So if we have a supply shock, the dollar goes up, not down. Used to be the opposite. That makes it more expensive for Europe, who is short energy, or Asia, who's short energy. So those markets are going to struggle if crude does stay above 70 or 80 on Brent. And we are actually in a position to benefit from it. Final point, my new energy friends, now that I live in Colorado, said drill, baby, drill never worked in terms of having too low an energy price, so they didn't have the cash flow to be able to fund building out the infrastructure to be able to power the data centers.
Right.
At 70, the cash flow is going to be sufficient. They can build that infrastructure, and it's actually a net benefit.
Wow. So that's an amazing angle. I have not heard anyone talk about it, but that makes a lot of sense.
Yep.
And that's the key bottleneck right there. Wow.
That's right.
Good stuff.